When the CNBC Daily Open captures beneath its market-facing tone and headline-friendly language is not a moment of global stability, but a transition phase in which power, markets, and institutions are temporarily misaligned. The apparent calm in equities driven by relief rallies and tactical optimism exists alongside a hardening geopolitical environment where leverage, exclusion, and asymmetry bargaining are becoming a dominant tool of statecraft. This divergence between financial sentiment and structural reality is the defining feature of the current moment. At the center of the market narrative is the so-called takeout trade, shorthand for the belief that the Donald Trump escalates theoretically but ultimately retreats when faced with institutional, market, or allied resistance. From a trading perspective, this belief has become a behavioral anchor. Investors no longer treat tariff threats, territorial rhetoric, or diplomatic shocks as terminal risks. Instead, they treat them as volatility events to be faded. This mindset explains why US equities rallied after Trump walked back tariff threats against Europe. This was not an endorsement of policy coherence or geopolitical clarity, it was a wager on reversal. Markets are pricing in not strength but predictability under pressure. However, this market logic obscures a more consequential shift in global power dynamics. While attention drifts towards headline-grabbing issues such as Greenland, a far more consequential development is unfolding in Europe's strategic marginalization. Trilateral talks involving the United States, Russia, and Ukraine held without Euro participation signal a quiet but profound downgrade of Europe's role when Volodymyr Zelensky publicly accuses Europe of being lost. He is not engaging in rhetoric for domestic consumption. He is articulating a reality in which Europe lacks both autonomous military capacity and unified political will. In great power negotiations, absence is not neutrality, it is irrelevance. This exclusion reflects a broader pattern. Europe increasingly functions as an economic bloc without strategic sovereignty. It's about the consequences of conflict, sanctions, and supply chain disruptions, yet it doesn't sit at the table where outcomes are determined. The US Ukraine war, now entered its fourth year, has accelerated this reality rather than reversing it. The talks in the United Arab Emirates are therefore not merely diplomatic events, they are markets of hierarchy. Power is being exercised by those who can impose costs and guarantee outcomes, not by those who rely on moral persuasion or institutional memory. Against this backdrop, Trump's Board of Peace initiative for Gaza illustrates a widening gap between symbolism and enforcement. The creation of a new body of overseas reconstruction, followed almost immediately by the withdrawal of Canada's invitation, underscores the performative narrative of the initiative. Institutions without coherence capacity do not resolve conflicts, they narrate them. The exclusion of Canada after its Prime Minister warned against economic coercion is consistent with a worldview that treats multilateralism as conditional and loyalty as transactional. Peace in this framework is not shredded objective but a branded exercise attached to leverage. The Greenland episode, while seemingly erratic, fits neatly into this logic. Denmark's willingness to discuss a US missile defense architecture contrasted with Greenland's Prime Minister admitting ignorance of the deal's contents, reveals the mechanics of modern great power negotiations. Strategic assets are discussed at the level of security guarantors. Local sovereignty is addressed later, if at all. This is not a breakdown of norms, but their evolution. In an environment defined by deterrence and technology, geography matters more than consent, and defense infrastructure matters more than procedural transparency. Meanwhile, Asia presents an image of calm that masks structural drift. Japan's decision to raise its growth forecast while holding interest rates steady reflects an effort to manage expectations rather than ignite expansion. The Bank of Japan is not signaling renewed dynamism, it's signaling control. Japan policy posture prioritizes stability in the face of demographic decline, regional insecurity, and technological competition. The simultaneous weakness in technology stocks re-exasperated exacerbated by Intel's sharp decline, reinforces the point that global tech cycle is no longer purely cyclical, it is strategic. This strategic dimension is most visible in the semiconductor sector. The planned visit of Nvidia CEO to China highlights the tension between commercial imperatives and geopolitical constraints. Nvidia once derived a significant share of its data center revenues from China. Today, export control, licensing requirement, and the national security scrutiny have transformed chips into instruments of state power. Sales stall are not simple business setbacks, they are indicators of a fragmented technological order in which access is conditional and supply chains are politicized. Nvidia's engagement with China is therefore less about growth, more about preservation in a bifurcating world order. The TikTok venture follows the same pattern. Rather than banning the platform outright, the United States has opted for structural control through ownership and governance changes. This approach preserves the asset while reshaping who ultimately wields authority over it. In contemporary political power politics, outright destruction is inefficient. Control, delusion, and oversight are more effective. The TikTok arrangement demonstrated how economic openness is increasingly filtered through the security logic, with sovereignty negotiated not through treaties but through corporate structures. Taken together, these developments reveal why the current market rally should not be mistaken for a return to stability. Markets are responding to a short-term relief and behavioral pattern, not to long-term resolution. The geopolitical environment remains fragmented, hierarchical, and increasingly transactional. Europe sidelining the weaponization of technology, the erosion of multilateral norms, and the substitution of optics for governance all point towards a world in which power is concentrated among actors capable of absorbing risk and imposing outcomes. The central risk, therefore, is not sudden collapse but gradual mispricing. When markets consistently discount geopolitical escalation on the assumption of rhetorical retreat, they become vulnerable to structure shifts. They do not announce themselves through volatility. Power realignments rarely occur with single shock. They unfold through exclusions, quiet deals, and the normalization of asymmetry. By the time these shifts are reflected on asset prices, the adjustment is often abrupt. In this sense, the CNBC Daily Open is less a report on what has happened than a snapshot of systems of systems. It shows markets celebrating the absence of immediate damage while the architecture of global order is quietly rearranged. The surface appears calm, but the foundations are moving. Understanding this divergence is essential for everyone, because in such environments, complacency isn't neutral, it is a position, and often the weakest one.